So hydrogen stocks have performed very poorly in 2022, not only because of the massive macroeconomic headwinds, but also because of the fact that the hydrogen dream keeps getting pushed out every single year and investors have simply lost patience. So to start things off, let's get a metric for understanding how hydrogen stocks have performed in 2022. Now keep in mind, we have been in a bear market since the start of the year, so all major indices have underperformed, but hydrogen specifically has outperformed to the downside, being down on average around 55% according to the Global X Hydrogen ETF. And as you can see, this is led by big companies like Plug Power specifically struggling throughout 2022, as obviously the macroeconomic headwinds have reduced the amount of investment and revenue gains that these companies had experienced in 2021 and 2020. And even very well established players like Bloom Energy have struggled in 2022, not only because of stock price volatility, but again because of slower growth due to higher interest rates. But with all this slow growth coming in the context of macroeconomic headwinds, it's impossible for investors to really understand if hydrogen is going to take off based on stock price performance. Because it turns out a lot of businesses have actually been beating revenue estimates. The only thing that's been struggling is EPS. And obviously there's a very simple reason for that. EPS struggles in a macroeconomically tough situation where the company has to cut costs and revenue all of a sudden becomes lower margin. And because hydrogen companies need to spend a lot of money on R&D, they have to continue their cash burn for that specific sector on their income statement, as a result decreasing their EPS. But especially with the Inflation Reduction Act, the opportunity for investors in the clean hydrogen space cannot be understated. There is massive tailwinds coming from this act, and now that the Democrats seem to have control of the Senate, there's a bigger likelihood that future developments for this act for clean energy subsidies and even EVs could be passed. And with tax codes in place that could make green hydrogen cheaper than diesel at certain locations, there is massive opportunity for Plug Power, Bloom Energy, Nikola Motors, and all the other hydrogen stocks that I've personally been investing in over the past year. But I'm going to stop talking here and hand it over to a recent institutional conference conducted earlier this year where they analyzed not only the reasons why hydrogen has struggled to gain traction over the past 2 decades, but also what are the underlying factors taking place today that are putting in place for a massive hydrogen revolution this decade. And trust me guys, there's a lot of stuff on the media that is simply not covered by the data and the analysis that I'm just about to show you. So without further ado, let's get right into it.
Now, during 2020, hydrogen shares went from nice to have to need to have for all investors. Our constructed index yielded a return above 500%, even following a very strong 2019. In 2020, more country targets regarding the future of hydrogen were set, exemplified by EU's target for 40 gigawatt of installed electrolyzer capacity by 2030. Further, more company partnerships and targets were set, where the Green Hydrogen Catapult, formed in December 2020, perhaps was the most notable. But while all of this showed much promise and pointed toward significant opportunities in the equity market, 2021 told a completely different story. And yes, 2021 started off with a bang, but from the start of last year and until now, that same index is down roughly 45% and over 70% from the highs of January 2021. So why did this happen? Well, obviously, hydrogen shares were not the only growth shares taking a tumble last year, with several industries seeing valuations come down significantly from previous peaks. But that said, ESG-focused ETFs actually attracted almost $130 billion last year, up from $75 billion the year before, and we experienced several catalysts, such as the US infrastructure plan and EU taxonomy requirements, which all perhaps should have spurred share price appreciations. But we learned that building the hydrogen economy will take time. We learned that the hydrogen industry definitely is exposed to uncertainty linked to government support, such as stimulus delays or incentive cuts announcements. And with investor focus among the more developed hydrogen companies shifting towards fundamentals rather than just pure contract announcements, as well as the policy rate being lifted, hydrogen shares suffered. But among the gloomy picture in the hydrogen equity market last year, several underlying market developments gave us some new insights in 2021. First of all, gas prices skyrocketed as a result of this energy supply-demand imbalance. And at the moment, as you've probably heard a couple of times previously today, we are at prices around 90 euro per megawatt hour in Europe. And second, prices of CO2 also increased massively, which also has continued into 2022. The price of carbon in the EU is now around €90 per ton. And both of these factors heavily impact the cost of hydrogen production. With natural gas being the most common input factor in hydrogen production today, it highlights that the time for cleaner hydrogen production to be competitive with polluting alternatives might be closer than we think. So how does this then translate to the actual production costs of hydrogen? Firstly, let's look at the cost of carbon capture and storage and when blue hydrogen becomes competitive with grey. Now, assuming a project in Northern Europe and gas prices at average levels over the last 5 years at around €20 per megawatt hour, blue hydrogen becomes cost competitive with grey with carbon prices between 60 to 65 euros per ton. And given the EU's Fit for 55 strategy, carbon prices should stay at such high levels. So blue hydrogen is now already profitable versus grey under normal energy market conditions, at least in this scenario. And for reference, all of these prices in this and in the following examples are pure production costs, not factoring in initial capex and hence reflecting the full levelized cost of hydrogen. So, a green hydrogen project in the same geographical area would at historic power prices at around €40 per megawatt hour cost between €4 to €5 per kilo to produce, depending of course on the technology. But just like the gas prices, power prices have been at record highs during the last year. And reflecting levels as traded during the last year, such as up to €300 per megawatt hour, the cost of green hydrogen becomes extremely expensive. It actually pushes the €20 mark per kilo hydrogen produced in the most extreme scenarios. However, there is one vital point we have failed to address thus far. Because with wholesale market prices as the cost of energy input, green hydrogen is twice as expensive as grey or blue. But most green hydrogen projects source power through long-term renewable power purchase agreements, or PPAs in short. And because of this, there has been many cases in Europe this fall where it has been substantially cheaper to produce green hydrogen compared to grey and blue. And this highlights what we believe will be one of the most important things for owners of green hydrogen infrastructure in 2022 and in the years to follow, namely securing favorable PPAs. And the tight and volatile power markets have definitely highlighted the importance of a gradual and controlled slowdown of fossil fuels. But it has simultaneously showed the need for a rapid buildup of a hydrogen industry to serve as storage, add to, and of course down the road, replace fossil gases in power generation and in heavy industries. So where are we right now? Well, in terms of scaling up the hydrogen economy, electrolyzer capacity does not look to be a bottleneck, at least in the next couple of years. Because looking at the announced capacity plans and build-outs, we look to be oversupplied until the latter half of this decade. And while that bodes very well in terms of lowering the cost for electrolyzers for hydrogen producers, the OEMs might be in for a substantial margin pressure.
And that right there is exactly why hydrogen has struggled over the past 50 years. We have simply not seen the amount of electrolyzer deployments that we have seen over the past decade, as not only the cost of the technology has come down, but more and more businesses have started to see this opportunity and create innovative business models around them to, at the end of the day, create more revenue from the product. And because of this, the economies of scale will start ramping up significantly this decade, resulting in a collapse of green hydrogen, blue hydrogen, and even gray hydrogen prices. Because as the race to decarbonize strengthens and more companies are forced to cut their emissions, hydrogen technology is going to become at the forefront of this charge because it is the only effective way to decarbonize heavy-duty transportation, cars, buses, and even airplanes. And like I've already mentioned countless times, in the longer term, hydrogen is the perfect energy buffer for high-capacity renewable energy resources, so you can store your energy and use it whenever you want within the next couple of months. And obviously that is something you simply cannot do cost-effectively right now with batteries. And then obviously if you pair that with the fact that supply of hydrogen companies is also increasing with a record number of startups in this space, a lot of innovation and cost reductions in this space are already starting to take off, resulting in a double-edged sword for hydrogen prices to come down. Guess what? As prices come down, that's when commercial adoption really starts taking off.